Hey everyone, it's Brandon from the Young Investors Podcast. Myself and Hamish are excited to bring you your weekly rundown of the latest business and investing news from around the world. A quick reminder before we get started that any advice provided by myself is general and does not consider your financial situation, needs, or objectives, so consider whether it's right for you. Brandon Kolk is authorised to provide general financial product advice in Australia and is authorised representative 1305795 of Guideway Financial Services Proprietary Limited, AFSL 420367. Please see the description box for my financial services guide. Past performance is not a reliable indicator of future investment returns, but with that said, let's get into another episode of the Young Investors Podcast. All right, guys, welcome back to the Young Investors Podcast. We are having some good laughs off air, but we are back. We got to lock in. Hamish, how you doing, mate?
I'm doing great. Yeah, it's so good doing these podcasts. It's so much more free flowing. It's so fun. Yeah,
being in person just brings such a better dynamic, and it's also because we don't have to deal with the lag.
Yeah, I know. Yeah. We'll one day soon, hopefully, we'll be able to do these in person regularly. So hopefully that'll be the case.
It's so tough because when we're on the calls, and normally there's like a second of lag, what we don't want to fall into is the trap of constantly like going back and forth with each other, because then it ends up being like, no, you go. No, you go. It's like, it just gets too clunky. Yeah. But here we don't have to worry about that. And what it means with our podcasting regularly is it tends to be I let you talk and then you finish, and then I talk and I finish. But this is just so good that we can just...
And it's like not really how a good conversation goes. Like some person's talking, like just like saying like a slab of text, and then like the next person goes. So it is so much easier doing it like this.
It's so interesting how attuned our ears are to conversation. And you can tell immediately when just like the tiniest little thing is just out of place. Yeah. It's so interesting with audio. I mean, you can tell it straight away. Even like if we just, I mean, people were probably just hearing that dead air for like 1 second, we're probably like, oh, what? Even though it's like, it's just a second of silence. But we're so attuned to that it's just like, whoa, what?
Yeah.
It's weird. Anyway, welcome everyone.
Welcome back.
Welcome to the Young Investors Podcast.
What are we talking about today?
We are going, so I put out the call, and as did you, for questions.
Yep.
If anyone had any questions, and we got quite a few questions that were asking the same thing from different perspectives.
Right.
And the question that was really being asked is, how do you invest right now in what is perceived to be an overvalued market?
Yes.
So that is what we're going to be talking about in this podcast, and we are going to put a couple of different hats on. We're going to put on the kind of the value investing hat, and we'll also put on the passive investing hat, and just talk about we're not going to give any directions and tell you guys how to invest, because obviously that's up to you guys. But we're probably going to just talk about some different philosophies and what other investors following that approach do in these kind of times and that kind of thing.
Yeah, all I was going to say is like the backdrop of this, I guess, is what are we at? We're the 30th of July, and I was just taking a look at the S&P 500 is up 15.2% this year. The NASDAQ, of kind of the mostly tech-related companies in the US, is up 17.6%, and the ASX 300 is up, it's up 4%. So the Australian market hasn't done that well, but particularly the US market has been very, very hot. And I mean, we've spoken about this a lot. You know, there's obviously an enormous concentration. I don't know the exact percent, but I think it's more than 30% now in those the Magnificent Seven companies.
God, we love them.
We do love them. And particularly NVIDIA has been kind of leading the charge, up 132% year to date.
It's pretty wild.
And so it's been hot.
Yeah, we've got a very interesting market dynamic now when we're talking about the US market, where there is it's more concentrated than it ever has been, which is really weird, especially for passive investors, because passive investors like to spread their money across all the companies.
Yeah.
But as a passive investor, if you're buying the S&P 500 right now, you are more concentrated than you have ever been.
Yeah. And I think, again, I don't know the exact number, but it's something like, I think 7% of the S&P 500 is just NVIDIA, I believe.
Yep.
And so, if you're buying an S&P 500 index, about 1/15 of the money that you invest is going into a single company. So
I've actually got the stats right here. I can tell them to you. Microsoft is 6.89% of the S&P. Apple is 6.85%. Nvidia is 6.06%. And then it drops down. Alphabet split, but Amazon is 3.64. Meta is 2.2. So we've got three companies, Microsoft, Apple, and Nvidia, which right now each occupy more than 6% of the S&P 500.
Yeah. So what's that, like 18%, 19% going into three companies, which kind of sounds like an active portfolio.
It does, doesn't it?
If you obviously take out the fact that, if you're buying the index, you're obviously not thinking about it. But a lot of your money is going into a very concentrated few companies. And I believe the last time the market was anywhere near this concentrated was the tech bubble in the year around the year 2000. And so that is, I think, the backdrop that kind of brings up this idea of, well, we've kind of got AI. Back then it was the internet, concentrated market, everything's surging. There's a lot of hype. Every conference call is AI.
Yep. When they're not quite showing the returns yet from that.
And there's no money coming from it. There's just money pouring into it.
Yep.
And so I think, it's fairly rational to, especially if you're just someone who's just kind of participating in the markets, you're not super involved, to ask the question, is it expensive?
And that's the thing. Yeah. So we're going to be talking about how to invest in an overvalued market. But the first question is, well, as you say, is this market overvalued? Like what are the metrics around that? And we can talk about individual stocks and concentration and that sort of thing.
Yeah.
But I think there's never a perfect way of saying whether the market's overvalued, but a reasonably good way of looking at it, I think, is through the Shiller PE. Do you follow the Shiller PE?
I look at it every now and then. Give us a backdrop of what it is, just for those who might not know.
It's a cyclically adjusted PE ratio. So you think of it, it's a price to earnings ratio. So what are the earnings versus what investors are willing to pay as a price? But it does that for the S&P 500. And the earnings side of it is the average inflation adjusted earnings of the S&P 500 over the last 10 years.
Yeah.
So it's like a conservative PE ratio for the S&P 500.
Yep.
And you can think about it when we talk about individual stocks. We can say, generally, if you found a company with a PE ratio of 10, you might say, oh, that looks pretty cheap on paper. Obviously, there needs to be context for each one of these examples, but you might say 10 is like, oh, that's quite cheap. 18 to 20, you might be saying, okay, that's roughly fair. And then if we're getting 30, 40, 50, 100, then you're saying, wow, that's an overhyped stock.
Yeah.
And right now, what we're seeing for the entire S&P 500 is a Shiller PE of 35. So that's all 500 companies lumped together.
Yeah.
Those companies have a cyclically adjusted PE ratio of 35.
The one thing I will add is maybe just to give it even a little bit more context to the PE ratio, for people maybe who are wondering a little bit more about, like, why do we care about this? Well, investing is outlaying money to get more back, right? And the money you're outlaying is the price. That's the kind of the price part of the ratio.
Yep.
And what do you get back? Well, you're a shareholder, so you get a share of the profits of that company, and that's the earnings.
Yep.
And so as you said, like if a company has a PE of a 10, and let's say their earnings didn't change, it just was the same for the next 10 years, and you paid a PE of 10, well, that's like a payback period of 10 years. You pay $100, and every year the company produces 10, and after 10 years, you've gotten your $100 back.
Yep.
And so, as you said, the higher this PE is, the more that the earnings of those companies need to grow for you to get your money back, for that investment to actually make sense.
Yeah. So as of right now, the S&P 500 has to keep S&P 500ing for 35 years.
As it does.
Yeah. For 35 years before you get your money back. Now, of course, there'll be growth in earnings over that time. But that's what you're committing to right now. Yeah.
Exactly. And that is why it's so high. Like, exactly. Someone might be wondering, well, how could it even be 35? That's insane. Why would anyone invest and wait 35 years just to get their initial investment back? But that's because the market is expecting an enormous amount of growth in earnings.
Yep.
And yes, a large part of that is related to this, AI stuff I think you're going to talk about.
Yeah, so I was going to say, so that's kind of the Shiller PE ratio of 35. And you can say, well, does that mean the market's expensive? Of course, it's all relative. However, if we look to history, a Shiller PE of 35 would say it's quite expensive. For example, we've only seen a Shiller PE this high roughly 3 moments in history. They were 2021, so very, very rampant bull market. 1999, again, rampant overvaluated bull market. And also 1929 before the Great Depression, which again was a massive hype market.
Yeah.
So, and again, we're not making predictions. We're not in the game of making predictions. So we're not saying that, the market's going to fall off a cliff or anything. Who knows what will happen?
Yeah.
But it just means that investors are willing to pay a lot more for the S&P 500 than they usually would be.
Yes.
And that seems that makes it seem quite expensive. And I've put another couple of reasons here, but we've already kind of spoken about it. The Magnificent Seven have obviously driven the S&P 500 to all-time highs on the back of AI speculation, and that's a big part of the overvaluation at the moment. Is that investors are making bets on these large 7 companies at the top end of the market, which are such a large percentage of the market. AI, we're saying it's going to be a revolutionary technology of the future. It's going to help, it's going to kill jobs and it's going to help companies become more profitable. And it's just going to be amazing, Hamish. But we're yet to obviously see that reality. So right now, investors are making these bets and bidding up the price of the market in hope for an AI future where they get paid back more than the amount that they have to pay up now.
Yeah.
So
I think that is like the most important element to understand is a high PE doesn't necessarily mean that it is overvalued. It's just, it gives us kind of some historical context of where market expectations are. And, a good example of that is, you could have bought, what's a good example of this? You could have bought Amazon stock, 1,000 times earnings, very early on. And you still would have done incredibly well. Why? Because their earnings grew an enormous amount from the last 20 years. Or I think Walmart's another good example where there was a crazy example where you could have paid 1,000 times earnings or something back in the 80s or something. And you still did fine, right? And so that's kind of the missing element of the PE is the growth of earnings.
Yep.
And that's where you'll get into a debate of whether the PE, looking at a market PE, whether you can tell whether the market is overvalued. I would probably take the perspective of unless you have a good idea of what the earnings growth is going to look like, you probably can't tell broadly if the market is overvalued. But yeah, certainly you can look at it in a historical context, and it does seem to indicate at least there's some frothiness. My favorite word now.
Bringing it back. Yeah. Thanks, Ray. For that one.
Thank you.
Okay, so with that said, for the purposes of this podcast, Hamish, we're talking about how to invest in an overvalued market. So I'm just going to call it and say that the market's overvalued. Okay. I don't care what you think. Because if you say that it's not overvalued, then the rest of this podcast gets a lot harder. No, so we're going to now, put on a couple of different hats. We got a few different questions from people around this topic. So I think we'll start with the value investor's perspective. So we're talking how to invest in an overvalued market from the value investor's perspective. So the question that we had was, in such an expensive environment, how do value investors navigate current trends? One of the main takeaways from Omaha this year was cash is not currently trash, but the momentum trade has been the headline for some time now. So value investing, I guess, how would we summarize it? It's buying great companies at reasonable prices, at fair prices.
Yep.
And I think you could probably make the argument that a lot of the great businesses, probably more at the top end of the S&P 500 that a lot of people look at, they're not anywhere near a fair price.
No, I would definitely agree with that.
Yeah.
And these are kind of broad statements. Obviously, on an individual basis, things are different. But broadly speaking, if the business is doing well and it's a great business, investors are probably going to have over-optimism about its future, and therefore its price isn't going to be appropriate where you can kind of get in at a reasonable price.
Yep.
At least that's been my experience, is if I want to own a really good company, you usually have to buy it when it's going through some kind of problem, when there is some uncertainty in the short term about how they're going to perform. And for a lot of the big name companies that you would pretty quickly say is a good business, is a great business, like a Google or a Microsoft, things are going pretty well, or at least
Yeah.
the investor perception is that things are going really well. And that makes it difficult because then, you can still invest in those companies. And if they do perform really well, you'll do well. But from a value investor perspective, you don't want to be betting on them hitting the home run. You want, that's a nice possibility. But you kind of want them to you want to bet on a great business doing pretty good. And the only way you can do that and still get a good return is if you're buying the stock cheap.
Kind of reminds me of what we were talking about recently with Google's earnings. How we were talking about, we looked at their earnings and they were pretty good, like double-digit revenue growth, like good improving operating margins and very solid net income. Yet on the earnings release, the stock fell like 5-6%, something like that.
Yeah.
And it just shows you that in that instance, everything needs to kind of go right.
Yes.
Like investors have bid it up to a price where they are expecting perfection. And therefore, if they don't get perfection, then the price suffers.
Yes.
So it's a very interesting kind of perspective. But my question then to you, Hamish, is we've outlaid this situation where it's quite hard to find stocks to invest in from a value investor's perspective, great companies at reasonable prices. So when you are, because you wear this hat, you are in part a value investor. What's your tips on navigating an overvalued market? How do you personally go about your own investing in times like this?
I would say there's a couple of things. I think it's important to recognize that even if it is a broadly expensive market, that doesn't mean there's no opportunities anywhere. Different industries, broadly the economy might be doing well, maybe interest rates are going down and, consumers are spending more. So broadly businesses are doing well, but there's always industries going through their own unique problems, or even one business in an industry going through a unique problem. A couple of, this isn't maybe something I would be willing to go into, but a couple of Warren Buffett's great investments have been in companies going through some kind of fraud investigation, for example, like American Express. One of his famous investments, it's obviously an incredible company, and he was buying it through some fraud investigation, right? So regardless of what the market is doing, the stock is doing bad because of a company-specific event. Now, in that case, you'd have to be able to analyze the fraud situation for yourself, and that's probably something I personally wouldn't be able to do. But it's to say that just because it's an expensive market doesn't mean there's no opportunities. Just because the Shiller PE is 35 doesn't mean you wouldn't buy any individual company. And so I think that's important to kind of understand is when you're a value investor, you're looking at companies on an individual basis. What the rest of the market is doing is kind of irrelevant. It is true that if there was a recession and the whole market comes down, there's probably a good chance that there'll be more opportunities. But it doesn't mean there's no opportunities. And the other thing I would say is just because maybe you can't find something right now doesn't mean it isn't worth looking and building that watch list and continuing to stay up to date with the companies that you want to invest in and have that list ready, because things can change really quickly. And now I think we saw that in March of 2020. Things, changed very rapidly. It was like a 3-week period where stocks fell like 35%. And so if you don't have your kind of watch list ready, then you're not going to be able to learn about those companies in 3 weeks.
The opportunity will come and go, and you haven't been able to take advantage of it.
Yeah, exactly right. Exactly.
Yeah, I think that they're all really good points. The only other thing I might add to that is to navigate an overvalued market as a value investor. I think you have to turn over more stones, and you have to get comfortable. I think you have to get comfortable with the fact that value investors, as Charlie Munger would say, they don't make money. It's 99% weighting. I think what do they say? Like you don't make money
when stocks go up or stocks go down. It's in the
you make money while you wait. Yeah. I think a lot of value investors still don't quite appreciate just how lazy we should be as value investors. And no, you're not timing the market, because a lot of people say, "Oh, you're timing the market. You should still be investing." you don't think about whether the market's hot or whether it's cold or what it's doing.
Yeah.
You just think about the strategy, and you just keep going through the strategy, and you will find long-term success from staying rigid with the strategy.
Yep.
Looking at your circle of competence, trying to expand it at an appropriate rate, not going too crazy and trying to invest in some biotech company you know nothing about, but looking within your circle of competence, looking for businesses with moats, looking at management teams, running a valuation. There is that argument that we were talking about before, where if you have a business with you can see that it has a really long runway, a multi-decade runway, then I would be more inclined to pay a higher price for it, because if I am thinking like a value investor, I am thinking I'm going to hold it for 10 plus years.
Yeah.
So I can, no matter what the market does, I can stick around for this growth story. Hopefully it comes true. You keep tabs on it. But I think overall, you just have to stick to the strategy, and really get comfortable with the fact that when the market's hot, you won't find many opportunities.
Yeah.
And that's okay, because that's a natural protection mechanism built into the strategy. And then when something crazy happens in the market, you'll find lots of opportunities. But I'd rather be investing in those periods like 2020. Like in 2019, 2018, I don't think we were buying too many stocks. And then I remember when 2020 happened, we were keeping up to date with them. We were keeping our watch list up to date, like you were saying before. But when 2020 happened, we were calling each other at 1 a.m. saying, hey, are you pulling the trigger? Like, what do you think about this? What do you think about that?
Yeah.
Because we were starting to see margin of safety prices coming, not on everything. There was still a lot that was still overvalued that we wouldn't even touch. But there are a lot of instances in your own portfolio, I remember, if you've sinking money into companies where you're like, hang on, this was maybe not super expensive and now it's gotten cheap. And you seize those opportunities.
Yeah.
So
I can even give a specific example that kind of highlights this, because one company that I invested in recently, this is in 2022, this was Netflix stock, right? And back in 2020, Netflix stock really didn't decline, and that kind of makes sense because the pandemic, kept people in their homes, so their subscriber numbers did, kind of went up. So even though, broadly you could say things got cheap, that stock in particular didn't. And fast forward to it was early 2022, they went through their own company-specific problem, which was they started losing subscribers. And so there was a tech sell-off that came in 2023, or towards the end of, I think it was towards the end of 2022. Even though kind of tech broadly did go through kind of its broad sell-off, Netflix specifically went through that sell-off like 6 to 8 months before the rest of the tech sell-off.
Yep.
And so while tech was continuing to fall, that's when Netflix was recovering. And so I think that's kind of hopefully it's an example of kind of what I was kind of saying, which is broadly when Netflix was diving, everything was rosy.
Yeah.
But that didn't mean there wasn't an individual opportunity if, you understand the business and you thought it was cheap and that sort of thing.
Yeah, exactly right. I think that's it's very important to look for. There are 3 types of events, right? There's market-wide events, which happen very infrequently. There's sector or industry-wide events, which happen every so often. And then there's company-specific events.
Yep.
And as value investors, we're always on the lookout for those 3 types of events, because they are they create opportunities for us. But when the last time you bought a stock was what, 2022-ish?
Yeah, I think that's, sorry, just one more thing. Remind me. I think, if you're going to be picking individual companies, it's also really, I think maybe one of the most important things is to understand yourself and how much time you're willing to put into it. And even for someone like me, I still want to have a very good chunk of my money just going passively into the market, because I'm not full-time, I'm doing YouTube content full-time now, right? So I'm not full-time analyzing companies. I used to back 2018, 2019, 2020, I was very much into, going through all of the financials of a lot of companies. But today it's not something that I do that often. So I know that I'm not going to find as many opportunities, as you said. I'm not turning over as many stones as someone else. And so you have to think about that in how active, individual stocks fit into your portfolio.
Yep.
For a lot of people, it'll be nothing, and that's obviously completely fine. You'll probably do better than me because most passive people do better than people who pick active stocks. Or maybe you want a little bit because you like to, have, some individual picks, but you've just got to figure out what is suitable for you, I think.
Well, that's a good segue into now taking off the value investing hat and putting on the passive investing hat. Because a lot of the people that follow us in our content, because we are also passive investors, they like to be passive investors. So how do you invest in an overvalued market if you are dollar cost averaging into ETFs? Because a lot of people are finding it quite painful right now when they see the market just pushing these crazy new all-time highs, and then they're taking money that they've worked hard for, and then they're just dumping it in what they can kind of feel is a pretty bubbly AI-powered market, which is a fair enough question is a fair enough perspective to have. So the question we got is quite simply, if you think the market is overpriced and there are currently no screaming buys in individual stocks, would you still dollar cost average into an index fund or even hold cash? Well, let's start with the index fund.
Yeah, give us your perspective on this first, and then I'll come in on this.
My perspective on this is that as a passive investor, you are adopting so I think about it as a strategy, right? So value investing is a strategy. And if you follow the strategy, you'll get decent returns out of that strategy. Passive investing is another strategy. If you follow the strategy, you'll get average returns out of the strategy, which is what you're aiming for.
Yep.
So if you're a passive investor, my thought process has always been I'm implementing a strategy, dollar cost averaging, where I invest the same sum of money periodically at the same time intervals. And the reason I'm doing that is so that no matter whether the market goes up, goes down, or goes sideways, I get the average. I get what the market gets. I'm structuring my strategy so that I actually do get what the market gets. And then what we're trusting, the trust part of that, is that we're trusting that the future of the S&P 500 looks somewhat similar to the past and does give us a reasonable return. Yep. History suggests that that return might be around 10% per year. Of course, the future hasn't happened, so we don't know if that's going to be the case, but that's the idea, is that we just trust in the average and we accept average, whatever that might be. So very long-winded, but that leads me to investing in an overvalued market. The perspective from my end anyway is the exact same if the question was, how do you invest in an undervalued market or in a market that's gone sideways for 10 years? And my perspective is that you are following a strategy that gives you average, which is what you want. So don't change the strategy. Just keep going, because you're not trying to beat the market with the strategy. You are just trying to get the market. Yep. So the only way to continue to get the market is to continue to invest in the market. So that's kind of how I think about it. I know a lot of people kind of do a hybrid dollar cost averaging approach where they invest dollar cost average until the market gets really frothy. And then maybe when the market crashes, they try and put a lot more money in at that point in time.
Yeah.
I don't subscribe to that because it just conflicts with the philosophy of passive investing that I'm trying to replicate.
Yeah.
What do you think?
Yeah, I agree with obviously everything you just said. And I think for me, at least, this comes back to kind of what we said at the beginning, which is, I think if you could know for a fact that, the earnings weren't going to live up to the expectations that the market thinks, and that, these companies are not going to be able to benefit as much from AI, and therefore the current expensive price of the market is unjustified, then maybe it would make sense to hold back from investing and wait until it got cheaper. I don't know if you can make that judgment. I think when you're broadly investing, like you said, you're kind of just accepting that you want to get the market average, that we don't really know what the earnings are going to do for the company, for these companies, particularly in the short term. And so you're willing to kind of just participate in the market. And historically, for there's more than 100 years of data on this now. Even if you were investing at some of the worst moments, you've still done. The return difference was not really that massive between the worst timing and the best timing. Whether you constantly bought at the peak of every crash or you bought at the bottom, the difference over the long term is extremely minimal.
Right. Okay.
And the neat thing about dollar cost averaging is if you're investing $1,000 every month, when stocks are expensive, you're buying less of them. And when stocks are cheap, you're buying more of them.
Genius.
And so it actually works out really well.
Yeah.
And so, if you're a passive investor, just stay the course. And too many people messaged me during 2020, for example, and sold their shares after the market went down for, quickly for 3 weeks, because they had this kind of perception that they could see the market was going to get worse.
Recency bias.
And that's just almost always going to be a mistake, I think. So trying to think that you can time the market is probably not going to work out well for you. So just stay the course. And if you can, then you don't really have anything to worry about.
Yep. No, I agree. That I think that pretty much sums up the passive investing during overvalued markets. And then the last one I kind of just tacked on to the end of this is talking about cash balances. Obviously, overvalued market, maybe you're keeping more cash on the sidelines, or you're just naturally building it up because you're not having very many opportunities. So how do you think about cash? The question we've got, Hamish, is are you guys sitting on a lot of cash at the moment? How do you manage the cash pile in conditions like these? So maybe if you've got a build-up of cash, do you put more into your dollar cost averaging, or do you just keep it on the side? I think this one, there's not so much of a rigid generally accepted answer. So what's your kind of take on how you manage a cash position?
Okay, so I mean, from like a value investing perspective, you when it comes to cash, my kind of view is I'm not ever specifically trying to build cash or like keep cash on the sideline. Cash only exists in the absence of opportunity. Like if I can't find something to buy, I'm not just going to throw money in the stock market into individual stocks. I'm not just going to throw money at individual stocks. If I can't find something, I'm happy to let the cash build and have some patience, knowing that there's probably going to be an opportunity at some point to put that money in.
Yep.
And so cash only builds up through kind of dividends coming in, and I just let them kind of build up. And then also I obviously contribute my income into the portfolio. And then I have my passive investing dollar cost average plan that doesn't really change. The good thing about the environment we're in right now is that there's much less of an opportunity cost to have more cash. And so, if you don't have an emergency fund, for example, now's the time to kind of build that up, because not only is that obviously a financially smart thing to do, but also you're earning probably 5% on that cash. And so the opportunity cost of being out of the market is much smaller than it was, let's say, in like 2018 when the interest rate was less than 1%.
Nothing.
And, if you missed out on a 12% stock market return and you had the cash earn 0.5%, that's obviously a lot worse than even this year. Sure, you would have missed out on 15% year to date if you're not in the market, but you still made 5%.
Yeah.
So the opportunity cost isn't as great. And so it's actually a little bit easier for people who are maybe not super around, why they should be investing. But for the most part, I'm almost completely always fully invested.
Yeah, I agree 100% with what you just said there. The only other thing that I might add, being a homeowner right now with an offset account, is it's similar where, cash is making you 5%, except in my instance, cash is actually making me 6.5%, because as that cash builds, I can also put it into my mortgage offset account, which negates the interest that I would pay on that certain amount of money that's in the offset account. So that's just a quick anecdote that I would say, is that if you're someone maybe out there with an offset account, or maybe you don't, and maybe you have a big fat mortgage, it might be something to consider. Of course, it's not financial advice, but it might be something to consider, because for my situation, it's actually even better than me keeping this buildup of cash in the bank, because instead of getting 5%, I can get 6.5% by just putting it in the offset account. But I agree with everything that you said. You're right. Naturally, the cash pile builds up. I think, again, the key to good successful investing is not feeling the pressure to have to do something. Like Charlie Munger says, just wait, wait. So I don't think if you have a lot of cash on the sidelines, the one thing you should not feel is pressure to put it somewhere. It can, sure, yes, you can look at all the historical stuff. Oh, cash over time doesn't perform, it loses its value. But it's also it's not a big deal. It's better to just sit in cash and earn your 5% at the moment on your cash, as opposed to sinking it into some stock that you haven't done enough DD on, you've seen overhyped, or that someone's telling you to buy, and then you're in a stock that you don't know why, and who
Yeah.
knows what happens with the share price.
Yeah.
You don't know what's coming tomorrow. So yeah, anything else to add on that, Hamish? I think that's pretty much everything. We've been going for 35 minutes. So I think that's a good little round out. Unless you have anything else to add.
No.
How to invest in an overvalued market?
Yeah, put all your money into Bitcoin. Into Dogecoin, and then
Yeah. Just like the US government's going to do when Trump gets elected.
Is FTT token still around? Buy some of that. Heard it's coming back.
Okay, so I do disclaimer that was sarcasm, and we definitely do not condone. Oh dear,
Speak for
Hamish.
yourself.
All right, okay, all right. Turn his microphone off, please. All right, we are going to get out of here. Thanks very much. I hope you guys enjoyed this little off the cuff episode. Hopefully that gives you some perspective. It is worth saying that, of course, none of this is financial advice. Everyone's situation is different, as was just evidence with you holding cash, me putting it into my mortgage and into my offset. It's going to be different for everybody. It just depends on what you subscribe to, what your financial position is, what your goals are. There's so many variables. And I probably will say that if you're concerned about what to do with your money, it's always worth checking with the financial advice.
Oh, wait, sorry. That's the...
You didn't cut his mic. Okay, I got to wrap this up real quick before you say something that's really going to get us in trouble.
Sorry. Continue.
But yes, financial advisors are definitely helpful. But with that said, we are going to bounce out of here. Cut the cameras, cut the mics. Goodbye, Hamish. And we'll see you guys next time.
See you guys.